All right, everyone, I'm about to get started. How are you doing? And I'm very excited to talk to you about passive real estate investing. And if you've ever invested in real estate before, do me a favor and just drop a thumbs up in the chat, or if you're completely brand new, but excited about passive investing in real estate, then drop a smiley face in the chat. Let me know. Real estate is one of the best ways to build wealth and passive income. If you didn't know that before, you'll be convinced of that here in a few minutes. Before I get started, though, if you do have any questions, drop them in the chat. Just at all, anytime during this webinar, be sure to drop it in the chat. And at the end, if there are any questions, I'll be sure to answer those. Quick disclosure, I'm not a financial advisor, planner, not a CPA, not an attorney. I am a licensed real estate agent in Texas, and I'm also an active real estate investor. Ultimately, my goal for you is to take what you learn here and use it, talk with your professional advisors, see how it can help you with your investment goals. We're going to be talking about in this presentation. One, I'm going to tell you a little bit more about me, my background, my experience, and also what makes real estate such an amazing investment vehicle. We're going to take a deeper look into the opportunity with multifamily real estate. You're going to learn about the benefits of passively investing in real estate and the most common ways to passively invest. We're going to touch on tax benefits that make real estate an amazing wealth preservation tool. And you're going to see a couple case studies of recent investments that we've done. So I got started in real estate back in 2004. This is a picture of me. Fashion's never really been my strong suit. So here I am sporting I don't know, maybe an Abercrombie shirt and some cargo shorts as a broke college student, but ended up buying this house. So I'm like 21, 22 years old at this point. So ended up buying this house for roughly $15,000. And ended up doing 3 other deals within the next 12 months. So within a 12-month period, flipped 4 houses, despite being in college with no job, and really I had no money outside that first deal. That first deal was my seed money, but ultimately I was able to do that using joint ventures and private lenders to invest in those deals, and they made a good passive return. The journey for me with real estate, even though it started in college, it didn't really kick off until 2011. That's when I got married, and my wife, she tells this story a lot better than I do. Got married, and it's like weeks later. She knew I did real estate before, but that was years ago, right? And I dropped this bomb in her lap. I'm like, "Hey, babe, I want to start flipping houses again." Because I was thinking about the future, about retirement and kids' college funds and private school and all that kind of stuff. She was very, very nervous, but went along with it. We ended up doing our first deal, and she was like, "Holy cow, this thing actually works!" And we've been running fast ever since. Got licensed in 2014. I still had a full-time job at this point. 2015, though, I was able to go full-time because that first deal I did, we ended up grossing over 6 figures. And actually several of our first deals ended up grossing over six figures when it came time to dispose of them. 2018, joined EXP Realty because a buddy of mine mentioned, a very respected investor, a friend of mine that I know, told me, I was like, "Hey, you can build wealth and passive income through this brokerage." And I was like, "Cool, like sign me up." It was a no-brainer because that's ultimately why I like real estate to begin with. Why not do it with my license? 2020 started Invested Agents, which really was birthed out of a local event that we were doing for years. But when COVID happened, like we all kind of got canceled, right? Everything live. So Jamie and I really went to the drawing boards to figure out how we can add more value and provide more content towards other real estate professionals or aspiring real estate professionals, to teach them how to build wealth and passive income with real estate. So, which is why I'm here, right? So we started that, and it's been a lot of fun. 2021, completely moved into large multifamily, and I'm going to show you a case study at the end of one of that large multifamily deal. $65 million in transactions over the years, raised over $19 million to fund our projects. We have 44 million assets under management. Most of that is a large multifamily. And then we have 393 units, including the multifamily, 200 flips. And with eXp Realty, one of the top 0.5% growth leaders of the entire company, which has just been amazing. We've got 150 something agents with 15, 20 agents joining every single month, and international at this point, because we've got agents in Spain and Mexico, as well as the United States. So this is my why. It's a picture of my why. It's why I get up every day before 5 a.m. I really do love real estate. I love what I do, even though it can be stressful at times. But ultimately, my family's my driver. Jamie and I talked early on, like in this real estate journey, like what we're really working for, and to be able to afford private school for our kids. And we were actually able to do that, and which turned out to be a really big blessing during COVID. And then we have Ellie, who will be entering private school next year, God willing. So they keep me going. Jamie's been very active in the business from the very beginning. That's my 8-year-old son, Nathan, and 5-year-old Ellie. And that's my why. So has anyone read this book? Like, if you've read this book, like, I don't know, drop a thumbs up or a heart in the comments. Let me know. 'Cause I read it in college, and it was massively impactful. Like, it was game changing for me, because it put a lot of thoughts in it organized a lot of thoughts in my head that I just didn't really have articulated in that way. And really, I learned more from this book than I did in an entire semester of finance and accounting. Now, most people watching now, this concept's probably elementary, but ultimately it outlined in the simplest form how money is made. But more importantly, it illustrated how money flows. It showed the importance of not only just buying assets, but buying assets that provide passive income. Because there's only so many hours we can work as a professional, right? Like, whether you're Elon Musk or you're an Uber driver, like, you only have 24 hours a day. We all only have 24 hours a day. But assets provide passive income, and that produces a compounding effect on our financial statement, to a point to where if your passive income exceeds your expenses, your wealth is infinite, because you could quit working your active job, your W-2 income, whatever that is, and your wealth is going to continually grow because it's more than your expenses. It's growing every single month. And real estate is really one of the best income producing assets you can own. And a few of those reasons, actually 6 of them, that make real estate the best investment vehicle, at least in my opinion, specifically with rental properties, is because you get income. Now, this is the rent, income through rent that's passive. You get equity gain. This is your tenants paying down your mortgage, paying down your debt on the property every single month. You get appreciation. Now, both in market appreciation, just the market forces doing what they do, and then forced appreciation by adding value, improving a property's physical, or in the case of commercial or multifamily properties, the financial condition. Leverage, using bank and investor funds to acquire assets, and significant tax benefits, like huge tax benefits, especially for high income earners. And then stability. So real estate typically doesn't experience the rapid short-term fluctuations that you see in stocks and bonds and equities. Now, real estate can be broken down into 4 primary classes. Residential being the largest, of course. And actually, residential is the single largest real investment class in the world. But you also have office, retail, industrial. We're going to focus on residential for this webinar, but more specifically, multifamily. Like many markets, real estate has experienced tremendous growth over the last 10 years. The market fundamentals remain strong, and the opportunity for residential real estate, especially multifamily, is going to continue to grow. We're going to look at finance, demographics. I'm going to show you the migration and immigration statistics, and also take a look at inflation and how real estate compares to inflation. So starting out with financial. This chart shows, and it's from the Housing and Urban Development HUD, and also U.S. Census data. It shows the growth of median household income in blue relative to median home sales, which you'll see in red. Both are trending upwards, but you'll notice that home prices start to outpace wages, and that they've been doing that since 2012. And then in 2020, they just completely skyrocketed because of COVID and supply issues, and the supply is really a primary driver. But this trend is making it increasingly difficult for first-time homebuyers. Super low interest rates have helped with the affordability factor, but rates are not going to remain this low forever. And the Fed is going to be increasing rates as they try to deal with inflation. And they've hinted at least a couple rate hikes for 2022. Demographics. This chart shows the U.S. population breakdown by generation. Home ownership rates for millennials significantly lags older generations. Affordability, it's the common theme, and that's due to increased financial burdens like the cost of rent, student loan debt, medical debt. All that helps. It hurts millennials from saving and ultimately being able to afford a mortgage. And really the loan that they would need to get the mortgage to get a home. But also, more Americans than ever are making the lifestyle choice to rent. Airbnb's founder, Brian Chesky, he's talked about this, about how a large percentage of Americans are choosing to rent. And in his case, or at least in his interest, more specifically, short-term rentals. He's seen this trend of this section of the population that they're okay just having that freedom and flexibility to rent and float around from place to place as needed. And this is going to continue to grow as virtual work environments permeate through the workforce. We've seen that in COVID, and that there is going to be a certain amount of jobs that can still be worked virtually, even when we get back in the office. But in Airbnb's case, nearly a third of all of their bookings are for 28 days or longer. And this trend is expected to continue with Generation Z, between the millennials and Generation Z, making a vast majority of the current American population. This map is from the U.S. Census Bureau. It shows net migration for each state over the last 10 years. It's really no surprise. Americans are leaving. They're moving high tax states, high regulation states, and they're moving to lower tax states, or states with more economic opportunity, which include Texas, the mountain region, and then Sunbelt states. And they've all experienced tremendous population growth because of this, which has helped their economies. And it's also caused a huge demand for housing. The Migration Policy Institute shows us how immigration has skyrocketed over the last 40 years. As of 2019, immigrants, as far as percentage of population in the United States, they make up nearly 15%. That's almost a 150-year high. It's pretty crazy, and it's not really showing much of a slowdown. Which immigrants, they need homes too, right? Then there's the current hot topic with the economy, inflation. All right. Inflation jumped 6.2% in October, the largest increase in 30 years. Core CPI, or Consumer Price Index, the core CPI is at 4.6%. That's after taking out food and energy prices, as if those don't impact, middle America. But regardless if we'll experience short-term inflation or long-term inflation, and depending on which government agency is talking, they're kind of in both camps. Real estate is an inflationary hedge. This chart shows the two most common inflation indexes. There's Consumer Price Index in blue, and then the personal consumption expenditures in orange. Both of those trending roughly along in the same pattern. And then you see multifamily structure values in green trending in the same direction, just further illustrating how real estate is a hedge against inflation from a value standpoint. But it's actually more, it's an inflationary hedge more than just by values, because it's also a tremendous wealth preservation tool. And that's because of the tax benefits. Now, the tax benefits are largely due to depreciation. Most multifamily properties undergo a cost segregation study after being acquired. Generally, a residential property is depreciated over 27 and a half years for tax purposes, but with a cost segregation study, that allows investors to accelerate some depreciation deductions over a 5 to 7 year period. And actually, in some cases, on year one. So that accelerated deduction has huge impacts on taxable income, especially for high income earners, and especially for those who qualify as a real estate professional. And I'm not going to go into what that is. It's definitely a good question to ask your CPA. But ultimately, what that does is allow real estate paper losses like depreciation to offset earned income across the board, like other earned income you have, like from a job. Now, as far as these tax benefits from an inflationary perspective, money in your pocket today is worth a lot more than money in your pocket tomorrow. So that's how it's both a wealth preservation tool from a tax benefit, but it actually plays into the inflationary hedge, not just in value, but just the fact that you're getting money in your pocket today that you can use and reinvest as needed. Okay, so you know how valuable real estate investments can be. You understand the opportunity with multifamily real estate, but what about passively investing in multifamily or really just kind of any real estate? The primary difference between active and passive investors is active investors leverage time, passive investors leverage money, their money. So active investors spend a ton of time on sales, both in acquisitions and dispositions, on asset management, on property management, and on finance, like fundraising and cash flow management. And all those tasks, they're ongoing. Like they don't stop. But that's what active investors do. They invest their time to earn income through the property, earn equity that way. Whereas most of the time for passive investors is spent on the front end, deciding what to invest in, doing the underwriting of a particular deal and deciding if it's worth putting their money. After they make that decision, all they really have to do is periodically review reports from management, making sure that they're doing their job, they're managing the property correctly, they're putting your money to good use. That's the big difference between active and passive investing. So there are three primary ways that you can passively invest in real estate. And each the benefits of each option, we've gone over the benefits of real estate. What I'm gonna do is I'm gonna kind of outline the three options, and we'll go through the various benefits. So there's a REIT, a real estate investment trust. They're generally publicly traded. If you were to invest, I mean, you're going to get cash flow, typically through dividends. As far as earning equity, you're not really going to earn equity in a REIT, but you could potentially get appreciation as the value of your shares, change over time, goes up in value. It can go down, but it could potentially go up, giving you a potential appreciation benefit. There's really not any leverage benefits, no tax benefits. As far as stability, the price of REITs can fluctuate rapidly in the short term. So you're going to have that stock market like fluctuations up or down. But it is very liquid. You can get in and out relatively quickly, just like you could a publicly traded stock. Now, a private lender has a few extra benefits, and a private lender is you loaning money to an investor. You're basically acting as the bank, and they're going to be paying you interest payments or a mortgage payment every single month, which is your cash flow. It's a great benefit, and a few of the case studies I'm going to show you is through private lenders. You're not really getting any equity. There's no appreciation. For very, very few private lenders are going to use leverage. Very sophisticated ones might, but it's not common, at least from a single investor level. Tax benefits, not really. Stability, you do have that because the assets, the valuation of a real estate property is not going to change wildly in the short term. And then liquidity, there's really not liquidity because you have the duration of whatever the term is that you signed with that particular lender or that borrower, whether it was 6 months, 5 years, 30 years, or whatever it was. You just have to write out that term. Now, you could sell your note on the secondary market. It's still a very illiquid asset because your asset is paper at this point. It's the note, and it's very illiquid, even if you did want to sell it. But a limited partner has has a lot more benefits. Pretty much everything we've talked about here. You get cash flow because actually defining a limited partner, essentially what you are in the deal. You own part of the deal, and it can look like the actual relationship and how you are in that deal and equity percentages and all this stuff. It can vary wildly, but in its basic sense, you are an equity partner. You own part of the deal, but you have no responsibility for management. That's why you're a limited partner. You also have limited liability because of that. But you do earn cash flow on your investment in the equity. Depending on the terms of the agreement, you're going to be earning cash flow. You have equity in the asset. You will benefit in appreciation of the asset. There's leverage because you and the entity and the operators almost certainly used some type of financing through a bank or hard money company or a lender to purchase the asset. You have tons of tax benefits. And this is one of the best benefits, at least in my opinion, of being a limited partner, especially over a private lender. And it's stable, again, because real estate prices typically don't vary wildly. And then the liquidity. Traditionally, it's about as liquid as a private lender. Like there is a secondary market, and with certain rules, you could sell it on the secondary market, but it's a very illiquid market. But the blockchain technology is changing that, and it's changing that very, very rapidly. Even today, that can be it's a vastly more liquid market than it was before. I would still call it illiquid at this point, but in the next few years, we're actually going to see that become more and more liquid. Not like it actually even it could potentially even be a little bit more liquid than a stock in the sense that blockchain technology can allow a transaction in seconds as opposed to a couple day settling period. which is what a lot of stocks have. All right, a couple of case studies. And again, if you got any questions, drop them in the notes. I'll be sure to go through those. So case study 120 Laurel Street. This property in the southern, actually it's in Lake Jackson, Texas. It's a 3-bed, 1-bath home. We bought it for $82,000, put in about $55,000, a little over in repairs. ARV $170,000, meaning after repair value. That's what it's worth now. Loan $128,000. And then interest rate. So this deal we bought from using a private lender in this case. So this was an investor who loaned us money to acquire the property. And the first investor, he was a short-term investor. So he wanted a short-term loan, 10% interest. And so we bought it, made the agreed upon payments. And when we rented it out, we actually refinanced with a long-term lender. In this case, it actually still is a private lender. It's not a bank. And this particular lender enjoys the cash flow long-term, doesn't like to do a lot of the work and the ins and outs like the short-term private lenders do. And he's earning 6% on the loan. This is another rental property, 7315 Willow Oak on the far east side of Houston. It's a 3-bed, 2-bath home. I've done a few different case studies on this one. And from the very beginning, this was just it was a hoarder house. It was a lot of fun to see the transformation, but it was definitely gross in the beginning. We bought it for about $104,000, put in a little over $55,000 in repairs. It's worth, the last time I checked, about $190,000 now. Probably more than that with COVID. I haven't checked in a while. Loan on it's $152,000, and then interest rate 6%. So this one we knew we were going to rent it out day one. So we actually went in straight with our long-term private lender, and at 6%, we already have it rented. It's been performing like a song, and our lender's been enjoying his monthly checks, just like we're enjoying the monthly rent. And then this one is Lake Forest Apartments. It was a Class B multifamily property in Daytona Beach, Florida. We are a small general partner in this particular deal. I know the operators well, and I respected them, and actually learned a lot through the process of how multifamily, how the actual operations from the acquisition to the reposition to syndication process works with large multifamily. So we were very excited to get into this deal. And so it's a 384 unit, $41.3 million price. Ended up being about $42 million, or a little over after closing costs. Equity, $12.3 million. So this equity, that's what we had to bring to the table for closing. And this equity was raised through limited partners. So the first two examples I mentioned were private lenders. Well, this is a limited partner play where we have $12.3 million that me and several other or the other general partners, we were able to raise through limited partners. These are folks that they're just going to be earning in this case, a preferred interest of 12% on their money throughout the duration of this deal. So they're going to be earning a very nice rate of return, and they're going to be getting a ton of tax benefits on this this asset that's just performing very, very well. So I'll be happy to answer any questions if we have any. So definitely drop them in the chat in just a minute. But in summary, went over the benefits of real estate investing and specifically multifamily. You saw how real estate is a hedge against inflation and how tax benefits make both a hedge against inflation and also a wealth preservation tool. Learned about the benefits of passively investing in real estate, and then showed you at least three of the most common ways to passively invest and the various benefits that go with each of those options. So be sure to connect with me on your favorite social media platform. I do answer every direct message. Feel free to reach out. Also, if you want to learn more about working with us and any upcoming investment opportunities, visit our website. Be happy to schedule a call with you. And let's check out the chat for any questions. All right. Okay. Well, I think what I'm gonna do is I'll hang out in the chat. I'm gonna go ahead and end the live stream. But again, if you got any chat, I'll be sure to go back in the questions. We'll leave this video up for about 24 hours. And otherwise, hope to connect with you again. Message me, connect with me. Thanks for watching.